Okay, today is Monday, July 4th. This is week 2. The session is being recorded. Welcome back. Hopefully everybody had a chance to go through all of the materials, work on the Nike assignment, which we're going to be discussing here in just a few minutes, and kind of set up week 3. But before we do, just any questions, comments about anything? All right, well, we have I just got 2 email notifications. We apparently have 2 late registrations. One, I believe, is Tyrone. Are you here? Send him a Zoom link. He'll be joining one of your teams, and somebody else is also going to be joining the session this week. And will probably be
That would be me.
Oh,
Thank you so much, Professor.
oh, I was trying to remember your name. Thank you. So yes, so what you need to do is that if you go, do you have access to Elms yet? Are you not registered?
Not yet. The registrar's office is working on it. They told me it probably wouldn't be done today, maybe tomorrow morning.
Yeah, when you do go to the people tab. Actually, let me show you. If you go to the people tab when you get access to the course,
Okay.
there's a sub-tab called Project Teams. We have 6 teams in this section. 3 of the teams are full.
Okay.
You and Tyrone, if he's listening to this video, will need to join one of those other Project Team 4, 5, or 6.
Okay, sounds good. Thank you, Professor. I appreciate it.
Please reach out to whoever you join quickly.
Okay.
As a matter of fact, while I'm on the screen, for next week, what I need each of the teams to do is decide on a publicly traded company that you want to do your group project on. I'd like to start it sooner rather than later, so that way the final project, as we mentioned last week, which is the final day of class and 40% of your grade, is going to be a presentation on the 4 sections of the class. So as you're doing the, for example, EIC section, a week later, you might want to start, working on the part of your presentation for EIC, et cetera. So I can start putting data in there. So an additional, just kind of verbal assignment, start talking amongst your teams, make sure everybody knows each other, and pick a publicly traded company. Doesn't have to be a US based company, but somebody that I wouldn't say don't do a startup. That would not be ideal in terms of data, because next week's assignment is going to involve analyzing 5 years of historical data, which means it's going to have 5 years of historical data in order to basically work for your group project. Right? It must be publicly traded, can't be private. So, and again, industry, whatever you guys are interested in. The only caveat is you can't do somebody we're talking about in the class. So Nike's off limits as an example, and direct peers of Nike. All right, so this week theme was kind of EIC, external environment. So you guys did the videos, did the assignment. You tell me, what were the takeaways? What's so important about the external environment? And what are we looking for? Yeah, John?
Oh, I think one of the main takeaways is that the external environment is responsible for 50%, I think was said, of the company's performance, what's going on around them.
Yeah. And what's funny is I can cite academic stuff all day long, but just, open your eyes and look around. I mean, we are in a macro trading environment right now, and it's a little bit of uncertainty that the market's trying to work through, but having very large impacts on companies, including Nike, as we're about to talk about. What other kind of insights did you guys have about EIC before we get into it?
By knowing like which external events kind of cause the most sensitivity within a company, you can see how they prepare for those events. So like with Nike, for example, um, tariffs were a big issue beforehand. And then since 2018, they started diversifying their supply chain to make sure that this doesn't happen again. And so like you would like to see companies that do that rather than, oh, it's a one-time event that's not going to happen again. This risk doesn't matter. It's not going to be mitigated.
Yep.
So like, yeah, it's good for companies so that they can mitigate risk.
And by the way, that ties into, we talked about last week, that future orientation of expectations and why it's so important to not just look backwards. Jacob?
Yeah, one major takeaway is just that, know your industry. Like, if you want to get rich, don't open a grocery store. Certain industries like airlines are just famously really low margin. So you may, be when you choose to enter an industry, you're essentially choosing what deck you're going to play with. And not all of them, are equally advantageous if, you're looking to, have a lot of good margins.
Yep. Industries matter. Anthony?
I thought it was really interesting just how broad like the apparel manufacturing industries shown on the Bloomberg index were for that, because it covered like a wide gambit of companies, and that kind of blew me away that they're all considered within the same industry, and it's like a luxury manufacturing powerhouse and then Skechers right next to it. It just seemed funny to me.
Well, and by the way, you are actually alluding to a real world challenge that we're going to show and illustrate in the class. Because, for example, when we get to multiples analysis, one of the things is picking a peer group, like who do you benchmark against? And it's not easy because there's very few companies in the world that just do one thing. And when you're in multiple businesses and when you're in multiple geographies, coming up with peer groups is a little bit less scientific than you may believe. But the one thing we all are competing for is capital. And that's what we tend to look at when we look at competition. But nonetheless, these are some real world issues that will come up, but regardless, the market does try and at least group some things together. And that's something we'll be talking about. But some industries, therefore, more attractive than others, and some parts of the industry is more attractive than others. And that's what we're trying to suss out and how that's changing over time. By the way, economic data, we're about to talk about what's coming out tomorrow that's going to be important. And why? Robert?
Based on the date, is there an FOMC meeting? Because they're normally the middle of the month, right?
Not tomorrow, I don't think.
Okay.
But it will whatever happens tomorrow will influence that meeting. Yeah, Jacob?
Is a jobs report coming out?
Well, inflation. Preliminary look at last month's inflation is coming out. And markets basically today is waiting with bated breath to basically see, like, are the tariffs actually starting to affect pricing? And that is going to be a big, look that everybody's kind of trying to read the tea leaves tomorrow to see how much of an impact on inflation it's already having. Because everybody believes it's going to raise inflation. They want to see data which is trailing to start to show whether or not it does. So that is going to have an impact on the market because it will affect interest rates and will affect discount rates. Robert?
Yeah, I'm curious how that's actually going to play in, just because he keeps backing off of so many of them. Like, I don't, how is that data useful at all if it's like, hey, we threw it on for a week and now it's off, and especially since all the companies sort of front loaded so much, and I don't, how does that going to do anything?
Are you referring to Taco?
Yeah, well, yeah, but is there anything in place? Like, is that data, is it any good? I guess is my question.
Well, I'll say one thing. They have fired enough people at the Bureau of Labor Statistics that people are starting to question the actual data, because the way inflation is supposed to work is they had a bunch of people who literally call all the manufacturers, but because they fired or early retirement, so many of them, they're now estimating the actual impacts rather than calling people to see what the real impacts are. So there's an underlying nervousness that is emerging in the market about the data that is being reported. That being said, there was an article in the, I think it was Wall Street Journal or New York Times today. It was on Bloomberg. But long story short, what they basically said is, yeah, he's all over the place with tariffs, but the bottom line, tariffs are higher. Like if you just kind of go through all the noise, tariffs really are higher, and that will impact pricing. And we're starting to see it, whether he backs off or not. The baseline tariffs have been going up, and the amount of industries and companies that are facing the tariffs have been going up, and that has had some challenges, which again, the market's trying to figure out whether it's going to play through. But the point is, these are important conversations, and part of E, as we're going to get into, is which companies are going to be more impacted by that. Some less so, some more so. And that's, if we're going to do valuation and understand a company, we have to understand that environment. Sometimes it matters more, sometimes it matters less. We're going into a world right now where I think it matters more. And so just to show you some things the market's going to be looking for, I'll go back to Bloomberg, give more real time. I showed you some of those videos from a while back, but let's look at it today. One of the things that we will track is at a very high level. So we're going to start talking about E's economy. And again, as I said in the video, rising tide rises all boats. So what's going on with economies around the world? Well, if you look at the latest data from Bloomberg, right now, we are not predicting a recession in 2025. They expect GDP growth to slow to 1.5, but not a recession. It's the data point right here. And the probability of recession, believe it or not, has actually come down. This was 50% 2 months ago. It's down to 35% today. And in case you're curious, where a lot of this data comes from is that just like there are analysts, sell-side analysts, which we talked about last week, which are forecasting companies' performance, there are economists, which are forecasting economic performance by country. And they're all uploading their data. So 72 different economists are uploading their data to Bloomberg. And this is just the average of all the guesses. It's median. So right now, if you look at GDP in the US, here a couple years, 1.5%, 1.6%, and 2%. But that's meaningful because if nothing else, if you look at the last 3 years versus the next 3 years, lower growth in the US. That's high level, maybe not a recession, but we're not going to be growing as the economy nearly as fast the next 3 years. And that will also apply to other countries. So for example, what's going on over in China. And they are seeing, for them, a little bit of a slowdown in growth. Now they target 5%, right? And it's just, that's their target. But 4% for them is actually a little recessionary. And it just has to do with the size of the company and the amount of people every year that are entering the labor force. But regardless, what you're starting to see as you jump around kind of country by country in real time these days is people's expectations are for slightly lower growth at a very high level globally, not just in the US, as you go, different regions of the world. Jaron? Jaron, you had your hand raised? Not hearing anything.
Hello?
Yeah, now I can.
Oh, yes. A quick question. Is this adjusted for inflation already or no?
Well, it's real GDP, so yeah, that's inflation adjusted. But
Okay.
you can actually see, I just switched to the EU, row number 2 is the CPI. So still relatively low inflation environment in Europe, 2%. Unemployment, though, higher in Europe, 6% is expected. And interest rates, 2%. But again, this is also, by the way, not to cross the politics, why Trump is having a fight with the Federal Reserve, because basically, as interest rates are rising, like massive budget deficits are going to continue because our biggest budget deficit now driver is going to be interest on the debt, right? So he wants cheap debt so that basically the budget deficits do not swell, and we have to borrow a lot more money, which drives up interest rates. So by the way, there's politics that's kind of entering into this economic fight, but that's going to play out in the economy, not just here, but in the US. As a matter of fact, I'll switch back to the US here. But just to give you a sense of what the market is looking at on a go-forward basis, and even in the context of Nike, I share some data, but like this is what companies like Nike are looking at. And if you look at unemployment, headline is going up, right? Not dramatically, but they do expect a little bit more unemployment. They expect slower growth in earnings. They do expect the budget deficits to be pretty large, 3 to 5%, 3 to 4% of GDP. And sorry, that's current account deficit, 6% of GDP budget deficits. That's unsustainable, especially in peacetime, non-recessionary peacetime. We shouldn't be spending that much more money than we make. But that being said, one of the drivers of GDP that's actually lowering GDP is government spending, because government spending is a key driver of GDP. And you can see with the expected budget cuts that they're proposing, that's actually where most of the growth of GDP is being tampered down. So cause and effect, but as I said, just high level, to kind of give you an update on what's kind of going on and what the market is predicting, and looking at this data, is tougher economic times the next few years. So that's just high level, even as we think about the Nike case. And then the other one, just to give you an update on, which I showed you in the video, was the economic surprise index. And is basically how are we doing against expectations here? And what should be concerning is bottom right. So those are the 6 buckets, as I mentioned in the video, of the surprise index. And all of them are the big red, which basically means every estimate that people have been making has been missed by category. We are missing expectation for housing. Article, I think in the New York Times today, 1/3 of the US housing market for real estate is in recession. Prices are collapsing. You do not want to own a condo in Florida right now. You can't give them away. Industrial production is coming down. Labor market not growing nearly as fast as we thought, even though it's not bottoming out. People are not spending as much money. People are not producing as much goods. And even though there's been a slight uptick in future expectations of the 6th one on the right, they're still very negative about the future. And when consumers are uncertain, they don't spend money. And that will affect the Nike case as well, because what's happening is people are trading down. As you saw in the analyst reports, the companies that are doing well right now are the discounters. People aren't spending as much on luxury, and they are holding back given the uncertainty on their spending. Although I will say the airlines just came out last week and said that it's not as bad as we thought, but it's still bad. They've been cutting back on flights, but nonetheless, airlines actually popped because of that. But regardless, those are just issues that will affect cash flows eventually. And so this is just part of our conversation. Tyrone?
I think the economic surprise index is pretty interesting. My question was, how volatile is this in comparison to, I know that there was a conversation earlier around like how the conversations around tariffs obviously have made a lot of projections. They've changed them throughout the year. Is this something that also will be affected by that? Like, let's say that there are reasonable negotiations made. Do you normally see this surprise index also like moving pretty, I'd say violently? Because I see everything's in the red right now.
I wouldn't use the word violently, but what I'm saying is, and this is what I kind of showed you in the video, Bloomberg started tracking this back in, the big recession we had in the housing crisis, 2008, 2009. And what they were basically showing is there's a correlation between uncertainty and market performance. And the more uncertainty we have, and we start missing expectations, it really affects the stock market. Like positive surprises tend to help the market, negative surprises tend to hurt the market, which gets back to the definition of risk, right? So I think we touched upon this last week, and I think it's a good reminder for you as we go through this session. Risk is not loss. Let's be really clear about that, right? In finance, risk is uncertainty, which means it's standard deviation, right? So I think what I showed you last week is we talked about, think about a bell curve, right? What could happen, right? That range of outcomes of what could happen describes your risk. When there's a lot of uncertainty, when I don't know what's going to happen, that's risk. When there's predictability, when I a very narrow range of outcomes, that's not risky. So the challenge we're having with the surprise index right now is that range of outcomes of the future has widened. And that's where risk premiums are starting to come in. Because when people have uncertainty about the future, it basically means we do two things. There's the behavioral science, which says, oh, I don't know what's going to happen, so maybe I'll slow down my decision making. And that's one of the impacts that we're starting to see play out. People are starting to pull back on some of their spending. And then number two, people are in finance are taught risk premium. More uncertainty, more volatility, more risk premium. Interest rates go higher, cost of capital is higher, hurdle rates are higher. And projects. I mean, I was on a call today with a CEO and CFO of a company I'm going to start to work with. And that was actually their point. Like, it's all about risk return. And if risks are up, returns got to go up. And if we don't see the returns with higher risk, we don't make the investments. I mean, it's just finance 101. So that's basically what's playing out here. It's just more at a macro level versus a company level. That's what we're trying to figure out. Okay. So let's talk about Nike in this context. Right. So I'll be specific with the data that I gave you as opposed to today. Go to this was the link to the data I gave you on Nike. And one of the things I gave you, as we talk about E, was this screenshot right here. So as you're answering this screenshot, what is the answer for E based on this screenshot? About economic sensitivity. Is Nike in an industry that is economically sensitive? Yeah, John?
The industry itself is slightly economic sensitive based on the 1.33 beta, but Nike with the 0.87 is below that average.
Yeah, historically. But if you're talking about a 1.33 beta, just so everybody knows, what does a 1.33 beta mean?
It moves 33% more in magnitude with the economy as a whole.
So Lisa, you want to add on to that?
Yeah, I was just gonna say, like, 1 means it's moving exactly with the market. So anything over 1 means it's more pronounced. Less than 1 would be less pronounced.
Yeah, and if it's more pronounced, that means we're going to call that more volatile, more risky. Okay, and that leads to higher risk premiums, essentially, right? And less than 1, less pronounced, lower risk premiums because you're not moving up and down as fast, right? But we know that historically, because this is a 2-year beta, that this athleisure apparel industry is pretty economically sensitive, right? Because its beta is higher than the average company. That's the first headline that you should have identified out of this data. Now, the second one John mentioned is when the second question is Nike. Nike's still economically sensitive, just historically not as sensitive as some of the industry, right? And so just contextually, why? Why do you think Nike is a little less sensitive? Yeah, Lisa?
I would guess like their brand equity would be related to it, like loyal customers who will buy no matter what.
Okay. I don't know if I'd use the word no matter what, but they do have some loyal customers.
I'm not one of them, so I'm like, no matter what, I won't buy.
Skip the no matter what part, but yes, I think they have a lot of brand equity, which tends to give them a little bit more predictability than some of the other companies. Yeah. What else? Christopher?
Yeah, so Nike has a pretty wide range of products offered too. They have, more luxury things you can buy, but they also have everyday shoes. which is versus some of the other companies in that category, like Louis Vuitton or Hermes. Those are easy cuts when the is bad for people because they're luxury goods. But your everyday shoes is still something people will need eventually. You know, if you wear a hole in the bottom of your sneakers.
Yeah, so shoes, shirts, apparel, etc., athleisure wear, workout gear. So that diversification probably balances out a little bit. What else, Tyler?
In the like readings, it said that Nike had like a well diversified demographic where it's like all income levels, not just the super wealthy or the super poor. So like even if prices go up, they still have a demographic willing to buy. And if prices go down, they also still have a demographic to go and buy it.
Okay, that I think that definitely helps them. Robert?
Kind of shifting more to like a quantitative perspective. Is it also due to them being perceived as lower risk compared to their industry, just based off the whack, as well as having a lower return compared to their industry, or no? I don't know how much that
I
plays.
mean, potentially you could make some correlation there, but I think if you just think through the implications of the economic drivers of that, I like to focus more on that. Because there's one thing I haven't heard from the group yet that also might help Nike be a little bit less risky than some of the other peers in the industry. Anthony?
Is it just the scale of Nike's operations and just how much product they move? I forget which one it said that was like almost 48% of the market was Nike shoes.
I'd say scale, but in a different way than you're saying it. Where else do they scale, Lisa?
So they, globally, like maybe they have a lot of markets where it's like, okay, if the US isn't doing hot, somewhere else is.
Yes, exactly. Like Nike's, if you think about their revenue, where it's coming from, Nike's a global firm. So they're not just tied to one country. So even if the US, has a little bit of challenge, they are still selling shoes in China and Europe and Latin America and Africa. So, but if you think about the big parts of their business, they are globally diversified. And I think that tends to mitigate some of the shifts, but they're still seeing some shifts, which we'll talk about, particularly some choices that previous management had made in the C section. But regardless, ultimately, this is an economically sensitive industry, should be your headline, right? And what I want you to start practicing, which was part of this assignment, that's why I want to give you the data, is not just do the math. Like what's causing that math? What are some of the assumptions that might lead to that math? I think what you're bringing up are what's driving some of that economic sensitivity. But the headline is, at minimum, you had to identify the 1.33 beta, that this is an industry that is 33% more cyclical than the average company, so therefore much more economically sensitive likely, and that Nike is a little less sensitive than its peers, and give some explanation for why. That's going to be the first part of the grading of the assignment. Anybody want to add? Okay, so that's the E, right? And then the other advanced part of this is, what are the real economic drivers that are most important to Nike at a macro level? What's going to really drive their performance in this macroeconomic conversation? Yeah, financially or others. Jacob?
Customer discretionary spending.
Exactly. And that goes back to the comment about that Lisa was making. So if people are pulling back because they don't want to spend $300 in Air Jordans right now or whatever, then that could affect Nike a little bit more at the high end, because they are more of a premium brand rather than a discount brand. Somebody pointed out they're not Skechers, right? And the other part that would affect Nike is what? At an economic level right now. Robert?
If we're not focused on like top line performance, then tariffs and how that impacts the bottom line.
Yeah, because it's cost and their supply chain, because they had moved a lot of their production and manufacturing from where to where. Where do they do most of their manufacturing these days? Robert?
Vietnam.
And if you think about the tariffs that were just slapped on Vietnam, that's raising their costs. And so I think, you know, historically Nike might have been a little less sensitive, but in today's environment, that might start to rise because their costs are a little bit more uncertain, whether you believe in the taco trade or not, because tariffs are higher on where they're making their products. And despite magical thinking, companies can't just snap their fingers and overnight move production and supply chains around the world to the US. And even if they did, they would be much higher costs here than they would there. So in either case, whether it's paying a tariff or paying massive amounts of investment for higher costs, like Nike is having challenges on an economic level, as are the other athleisure firms, which have continually outsourced to Southeast Asia from a low cost perspective long term. And now their cost inputs are starting to go up in the supply chain. And it's not just the manufacturing costs, it's also shipping costs beyond tariffs. Those have also been skyrocketing. And so that is putting pressure macro on this whole industry, right? Which is going to lead into our 5 forces conversation. Right? So, industry, okay? And the point of the industry is getting back to spread, right? I showed you last week, and we did some examples in class, that spread's important, and some industries have better spreads than others, right? And so what we want to do in I is not just observe the spreads, we want to explain the spreads. So the metaphor and model that we're using is 5 forces. So in the context of the 5 forces, we want to explain the spread that we observe. That was the next part of your assignment. That's the I. Right? So buyer power, supplier power, barriers to entry and exit, rivalry, and substitutions. Okay, so let's get the math out of the way, because you had to at least say this. Given this industry group that I gave you in the bottom slide, is this an attractive industry? And why? Or why not? Is Nike in an attractive industry? Tyler?
I said it was an attractive industry because their return is higher than their cost of capital. So overall, you'll be making money.
Okay, if I'm grading your paper, I'm not giving you credit because you didn't use numbers.
Okay. Let's see. The return on invested capital is 15.60%, and the WACC is only 11.12%, which is around a 4.50 or 48% difference. So that's their spread.
Exactly. So thank you for that. And by the way, replay this video. Listen to what he said the first time. If you haven't seen this screen before and you listen to what he said, you might not know what numbers he's talking about. So I'm just telling you, even in the real world, it's a very good practice to use numbers, because you throw up a chart, you're in front of some senior people, and you're referring to something, they're seeing the chart for the first time, you know the chart in and out, and you're referring to numbers without saying the numbers, and they don't know what you're following at. They don't know what number you're looking at. So it is a good practice, but regardless, it's required in this class. So for reasons that he just said, this is attractive industry. Okay. So Robert?
Just like curious, would you ever like kind of are you looking for more of like a binary answer with it, or like would you tier it? Like if they're barely beating, like if their spread is barely positive, would you still consider it an attractive industry, or just kind of like neutral? And like because there are, I think like one of the industries we looked at last week, like how much one had like a 10% spread or something, whereas
Well,
this one's like 4.5, give or take. So I'm
think
kind
of
of curious, like
ROIC like IRR, and think of WACC as R. If your IRR is higher than your R, you have a positive NPV. Now, if that positive NPV is like $1, and you said, you know what, this is virtually a zero spread, I would say I completely agree with you. So if the answer is 11.2% ROIC against 11.1% WACC, I'd call that a zero spread. That's not a very attractive industry. But if it's 12 or 13, companies will ramp that up sometimes, particularly in, capital intensive industries, because getting 2% on a huge investment for them might actually be a reasonable, NPV. So for math purposes, I want you to at least start with the math. Like if the ROIC is greater than WACC, it is a value creating industry. And then you can comment on why, degrees of it. But that's just the point I always want to start with, if that makes sense.
Thank you.
Okay. But nonetheless, so I think we've identified that. But then here's the point of the question. So you had to say that, and you had to use numbers when I'm grading. Number two, why? Okay. In the context of the 5 forces, why is this spread 15.6 against 11.12? What's causing this industry to currently have a positive spread? So what did you guys say? Start with any of the forces. Tyler? And by the way, I'm hearing from the same people, so I'm gonna start calling on people if I don't hear from different people.
I can pass it on too.
That's okay. I
Okay.
appreciate
So one thing that we talked about already, WAC, is kind of like a determination of like risk. So, as we can see in this industry, it's not very risky compared to other industries. Their beta doesn't move as like it moves with the market, but not too far like above the market or below the market. So it's not that risky. That's why the WAC is relatively lower. And then with the
Sorry, 11% you consider low?
generally I mean, based on what we looked at before, we've seen WACs that are like 20% or 6, like I don't know.
Those are international tech firms, but regardless, I want to be careful because beta is part of WAC, but when we think about risk, that's the result of the 5 forces. So
Okay.
I want you to talk about in context of the 5 forces. So tie risk to, is it buyer power that's causing the risk? Is it supplier power? Like what's driving that spread? 5 forces.
So let me see what I wrote.
Oh, you're thinking, I'm gonna start calling on people. So Brian.
Yeah, I mean, so what I put was the biggest driver for the 5 forces was rivalry. And so, there's a lot of different firms out there that are competing for business through a variety of different methods, whether it's promotions, whether it's price or style or so on. And so, from a 5 forces perspective, I thought the biggest one was rivalry.
But the implication, Ryan, is that rivalry is lowering the spread. Correct?
Okay, I see what you're saying. Yeah, I mean, yeah, that would be the implication.
You got to get rid of your biases. And this is important. Like I've had MBA classes before where we've done like the airline industry, and Southwest is always an interesting one for me because some professor gave them some Harvard case some years ago when Southwest was doing really, really well. And right now, Southwest is the worst performing of the major airlines. And they can't get out of their heads their tremendous historical success when they try to explain Southwest Airlines. I don't care what they did in the past. Today, 2025, July 2025, what is going on in this industry that explains the spread that we are observing over the last 12 months? That's got to be our perspective. And it may be different than what it was in the past. So when you say rivalry, absolutely, rivalry is affecting it. But the rivalry, I would say, doesn't seem to be hurting it if the industry is making 15.6%. Pat?
I would say the low bargaining power of the suppliers is helping drive the spread we're seeing. And then the threat of substitutes being people need clothes and shoes like we talked about earlier.
So you're saying that there's not a lot of substitutes to this type of apparel and athleisure?
I don't think there's a substitute for having a shoe or clothes. There is substitutes in terms of different brands. I forget what the term is for grocery stores.
The brands would probably be in the rivalry category.
Yeah.
So low substitutes and suppliers don't seem to have a lot of power. All right. I think that would be a good example of explaining some of the industry performance. Evan?
Yeah, so I wanted to touch on, I gave the buyer power rating a high category, and I did that because given the current macroeconomic events, and then cited within a couple of the different articles that you provided us, they did cite and had concerns about the frugal nature of the consumers And then also the impacts of the tariffs on production shifts the global markets that each company has a reach for. And they talked about, and this almost ties into the rivalry where Birkenstock, for example, is a domestic product, so they're not going to have any taxes, or tariff penalties, whereas Skechers would be massively overseas. So those types of different implications from the tariffs tied into consumer spending. I thought those two were closely knit. And then I also went and looked at Morningstar kind of selfishly to look at some recent Nike data. And there were concerns over losing the tariffs, having the impacts of losing those overseas markets, so to speak. And this is just a niche example for Nike, is 32% of the consumer base goes with a Chinese brand. And there are concerns from both the shareholders and the Nike marketing team that they need to continue to penetrate the Asian market.
Okay. The one thing I would just say, and I don't disagree with anything you just said, Evan, I want to differentiate the two questions of the I part of the assignment, which is what are the five forces today and what are the five forces in the future? And when you do today, I'm not sure everything that you just said is affecting them in the last 12 months, but because that's the data we're looking at. But I think going forward in the future five forces, then that's directly going to apply. So right now, if you think about buyer power, I think people don't seem to be exercising as much buyer power, because if you think about it, we're really talking more about, half of 24, early 2025, the economy is doing pretty well. People weren't trading down and people were spending money. And so I think in that context, I think the buyers were not exercising a lot of power over these athleisure firms. And I don't think we saw as much price competition amongst the firms. So Nike doesn't try to compete on price, right? As was said earlier, I think somebody mentioned it. They compete on brand, they compete on lifestyle, they compete on other things. They have all these endorsements and athletes and teams, etc. They don't try to discount, and so a lot of their peers do the same thing. Lululemon tries not to discount, although I did hear that they're being ripped off at Costco now by Kirkland in a giant lawsuit. In fact, my girlfriend just went there and scooped up as many as she could before they get taken off the shelves. But that's a quick aside. But that being said, ultimately, I think that's the point. A lot of these athleisure firms are not even trying to compete on price. Even Skechers, which is low cost, constantly sending out discount coupons, they're all about pushing that whatever it is, the easy, what do they call it? Where you just pop your foot in.
Like a slip-on?
Slip-ons. Yeah, I'm just saying they're competing on a technology or the marketing gimmick. They're not trying to just purely get you on price, because if you look at the prices, even with the discounts, they're not that cheap. And so that's the point. I think this industry, we from buyers have not been exercising the power that we have, because that's the other thing. Side note, I was walking through the Columbia Mall this weekend for the first time in 6 months, and I'm frightened at how much of a ghost town it's becoming. And what is scary is all the brands are leaving, and there's very few brands left. And I'm thinking to myself, we're seeing this consolidation of brands because we don't have the choices that we used to. And essentially the bigger companies are taking advantage of this because they either own all the brands, and you don't have the choices to go across the brands, or we're not making those choices, and they're not fighting with each other over the price. They're fighting on marketing and other features. And I think that has reduced the buyer power. That's personal opinion here. But as I'm trying to explain the 15.6, that's what we're trying to get to. Why is this industry doing well? Today, the buyers don't seem to be exerting a lot of the power that we otherwise have today. Okay. Robert?
So I kind of included this in the supplier thing, and I'm looking at thinking back on it. It's, I think, a lot more speculative, but I'm curious as to what your kind of opinion is on it. Do the tariffs that they at least keep threatening, but I know some are in place, yeah, whatever. Do they technically reduce supplier power? Because I mean, a lot of those manufacturers, I'm sure, would like to keep that business, so they might be able to concede in some areas, whereas Nike can just be like, oh, we're going to move this to a different country, which I know is like not always the most logical thing because it's a lot to kind of uproot your entire supply chain. But I'm curious, like, what you think in terms of that.
Well, as I said, I think in the short term, there has been some of that, but at some point, I don't know how long you can, because eventually, the margins get impacted in these supply chains along the way. And that's the other problem with supply chain, is that we're now seeing multiple impacts across the supply chain as we're kind of crossing countries. And then you get hit multiple times, particularly in North America. Because, for example, in auto industry, we make a part in the US, we ship it to Mexico for assembly, and it comes back to the US. Well, that's 2 tariffs. And so when you start getting multiple tariffs across the supply chain, you see higher costs, and eventually somebody's going to have to pay to move that along. I'm trying to get to a screen here.
I was gonna say, like, so like I work in commercial banking right now. Like we had a town hall for everybody across the country. And like in the DC area, there's not a whole lot of manufacturing just because cost of real estate and all that stuff. But like some of the areas that do have a lot of manufacturing and that we're importing like goods, we're saying like, oh, instead of manufacturing here, like we're now just gonna change our manufacturing to a foreign country, not have to deal with the import on like the raw materials, manufacture elsewhere, and just deal with the import duty on the finished product instead of, like you said, trying to have to do with that with like the raw materials. So
yeah. Well, the other part here is if we look at Nike and I look at some of their supply chain data, which is what I'm trying to get to here in their supply chain. These are their top suppliers. And these are their top customers. And this represents Nike's percentage of a supplier's revenue. And this represents Nike's percentage of a supplier's cost. Now, we're mixing metaphors here because we're talking about the industry, but I think Nike is representative of this. But the whole idea here is that a lot of these Asian manufacturers are relying on huge sales to a very few companies, Nike, Adidas, Lululemon, etc., and they have the power because it's almost like they're an oligopoly over these suppliers. And that's been the historical relationship. So I think in the short term, when you talk about the impact of the short-term tariffs, sure, they can go back to their suppliers and say, all right, you're going to eat some of this cost. But long term, I question that. So that's when we start to think about the future.
Yeah, I was definitely thinking very short term on that one. But yeah. Okay, thank you.
But I guess that's the other side, which is who are the customers? Remember, the customers are not you and me. Nike's not just selling to us, although 43% they're trying to go direct, but they also are selling to some of these big brands, Foot Locker, Kohl's, etc. And so how are they playing it? And as I said, consolidation of the retailers starting to put pressure as well, because they're going to start seeing higher and higher sales going to people like Foot Locker because there's no other, stores in the mall to sell through for discount retail, which is one of the reasons why they're trying to go direct, which has been one of the challenges that they've had. What about the other one, barriers to entry and exit? How does that impact this industry today? Anthony?
This is one I actually spent a lot of time thinking about because I was like, oh yeah, surely it's difficult to enter the market as an apparel manufacturer. But then like I saw someone wearing a brand of shoes that I had never seen. I'm like, what the hell is this? And like there's an enormous amount of like, I don't know, like direct to consumer like Instagram slop that I'm seeing. And it's like, I've never heard of this brand. How does this cost a nickel? And like people are buying it up like crazy. So like the barrier to entry has gotten very low recently. And I think that could eat into like the new entrants and high buyer power, like creates this like very difficult dynamic for an established brand.
So again, I think you're onto something, but I would like to differentiate. Today, starting to move in that direction, but I don't think really hurting the industry. 5 years, I think you're identifying a trend beyond fast fashion.
But,
people are happening. As a matter of fact,
thinking of today, like specifically with like Allbirds and like Hoka's and the On shoes, like those are shoe brands I had never heard of in the last like 5 years, and now everyone is wearing them.
I have a pair of
Um,
Hokas on right now.
yeah, like 5 years ago, if you asked me what that was, I'm like, I don't know what you're talking about.
Well,
Um,
I want to go a step further. Who's heard of Temu? Temu.
yeah,
Who's heard of Shine? Shein. What are they?
Chinese direct to consumer manufacturers,
But why are they relevant here to your comment?
because they're relatively new players
And what are they doing?
eating up consumer discretionary cash.
Yeah, but specifically in this context. Well, let me go back. What's fast fashion?
A direct competitor to Nike.
Who would be considered fast fashion?
H&M and Forever 21.
And Zara.
Yeah.
Okay? And the whole idea is that traditional retail would source 6 months in advance, seasons in advance, low cost contract manufacturing, ship it over, big bulk, big batch stuff. Hope you got it right. Sell during the season. Then fast fashion came along and said, no, we can get stuff in stores 30 to 45 days. And it's cheaper, more disposable, but we can also respond to consumer trends. What these guys are doing, and I'm not as TikToker as probably some of you might be, but they're literally taking what they see on TikTok, and within days, the contract manufacturers are putting it out there cheap. And that is completely being disruptive of the industry. Now it's emerging, but that's the trend, is that the speed of the supply chains is accelerating, and the responsiveness to the consumers and the data that we're giving them. Because it's not just TikTok, it's everything you're posting on Instagram and TikTok, they're monitoring and they're responding to those micro trends, and then they're pushing it. And you don't have to go through influencers anymore. You can just see the trends. And that's where retail is going. And I think from that perspective, that's where you're starting to see some of the barriers to entry come down, because consumers are responding less to the brand, because it still takes Nike months or even 60 days to identify, trend, manufacture, and bring it to market. If my competitor can do it in weeks, then that changes the game. And so I think over 5 years, then when it's about future five forces, it's going to become a much more emerging trend. Tyler?
I think one of the articles also stated like younger generations of buyers, 60% of their purchases are from social media influencers, whatever. And that's a huge percentage, especially when you account for like impulsive buys that they see it and they're like, okay, let me try it, let me buy it. And that's a lot of discretionary spending compared to like previous generations that didn't have this technology.
Absolutely. Matter of fact, what's the last summer was what? Brat summer. This summer's what's the new one? Is it You Go Girl or You Something Girl? I was up on TikTok. I heard about this. It's the new. It literally it's blowing up right now. There's this video. Is there any TikTokers here? It's Something Girl, and that's like the trend of the summer.
I don't know if it's a TikTok trend, but I know a lot of people around me, like my cousin's age, who are like in high school, be like, "Go piss girl" or something like that.
There's
But
variations of that.
yeah,
But I'm just saying, like, it started on TikTok, and it's now become extraordinarily viral. And now these retailers are picking up on that, and they're starting to market and capitalize on that. So I'm just saying it's endemic of what you're describing. And so I think when we think about future five forces, that's going to be the conversation. So the point I wanted to kind of summarize is, in the eye, we're explaining that this industry right now has a pretty positive spread. Okay, 15.6 against 11.1. All right, it's an attractive industry because buyers have some power, but we don't seem to be exercising it, because essentially the rivalry has not been on price, because we're facing more of an oligopolistic type of competition for this athleisure business. The supply chain historically has not had a lot of leverage over these retailers, and the barriers to entry are actually historically higher, because brand was a big barrier to entry, as was access to distribution, as was access to even those contract manufacturing suppliers. You can't just be Joe from Maryland and call somebody in China and order 10 shirts. Like, if you're going to do serious contract manufacturing, you need large orders, which means you've got to have distribution already set up. So the barriers to entry were relatively high in this business to get started at a more macro level. And I think that, along with the fact that, as pointed out earlier, weren't a lot of substitutes, it's why this industry has had a good spread. It's a very attractive industry historically, right? But what we started to cross the chasm into is the next part of the question. What's going to happen in 5 years? Okay. And that's the point. What we're really trying to do is we're trying to forecast what happens to this spread in 5 years. That's what's eventually relative to us from the financial context evaluation. But rather than just doing it by math, I want to talk about it in context of how the forces change. Because if the forces are getting more favorable, spread should go up. If the forces are getting less favorable, spread should go down. If the forces are about the same, spread should be about the same. That's the context for the future, right? And by the way, this one, it's harder for me to grade you on whether I agree with you or not, because we're talking about the future, but you still have to have some support for whatever future scenario you come up with. But I'm already hearing some of that in the way you're answering these questions. Because what I think I'm hearing is you're saying, look, substitutes may not change, but buyers are getting more power. And we're getting more access. And the rivalry is getting more intense because we're seeing some more non-traditional companies come in and have access to more micro markets with more micro manufacturing, with more trends about the customers that they can go after. And we're also starting to see some of the barriers to entry start to come down. Now, tariffs trying to create some barriers to entry. So there's some mixed messaging here, right? And then same thing with the supply chains. So power to suppliers, how's that going to play out given some of this disruption? But even if suppliers stay about the same, those other three trends suggest that this industry is probably going to likely have slightly lower spreads in the future. Now, that's one way to answer the question. You could answer the question differently. Did anybody answer it differently? Let me ask you this. You guys read the industry reports? What did the industry report say? Is it tracking with what we're talking about here? Bumik? Is it Bumik? Do I have that right?
Yeah, booming. Well, my answer was I said it might have a slightly higher spread due to one of my supporting reasons was the competitive landscape. I thought like maybe these smaller brands wouldn't last, and like due to like this, like you mentioned, getting into the supply chain and stuff like that. So I thought some of those brands wouldn't last, so maybe the competitive landscape might actually dwindle down a little bit within the next 5 years.
So there's an argument that maybe we're being too short-term in our thinking. And there's a reasonable probability that, as you said, longer term, what we're seeing is the structure of the industry going forward. And that could be more attractive. And I can't dispute that that's not a right answer. So that's the point. This is what I want to make sure that we're understanding. There is no necessarily one right answer. I'm more important in the process and supporting assumptions in the process. That's what's key to the grading. You can't have one without the other, not in this class. And you got to use data. All right. And you got to at least reference some data along the way. So I appreciate that. Robert?
Yeah, I was gonna say, I mean, I just kind of thought just because they have all the direct to consumer, as Anthony mentioned, all the Instagram brands and whatnot, but just the fact that they have so much data that they have on people now that it's so easy to target. I mean, like one of them was basically saying like 65% of Gen Z is influenced by social media, and that's kind of how they're gonna buy, whatever. And they're still, and Nike was still one of their big, one of the companies they're still shopping from, but it just seems like with all the data that they've gathered, it's so easy to kind of target the exact demographic that you want. And then I think just the fact that they're talking about AI and how they can basically incorporate that into, again, like it's not just targeting, but then they're like, oh, we can have you kind of design your own clothes, like, without us even getting involved. I just feel like there's so many different ways that the industry can kind of expand that I don't know.
Well, I think you brought up another excellent point, is that there's two things you brought up, and we hadn't talked about it previously, so I'm really glad you did. One is the data, okay, and how much data is now available about all of us that we are sharing. And I think they're accessing that. But number two is AI, and how AI plays a role in this, because it can synthesize and access and target much more efficiently than traditional marketers. And that micro targeting is something, even macro targeting, is something that people are leveraging, and I think is going to start changing this dynamic. I assume from a, well, you guys tell me, do you think it's more positive to this industry or more negative to the industry?
I mean, I think it's more probably more positive. I mean, we did, I think one of my last classes, we did a study on what's it called? Like, it's one of those, like, they basically mail you pieces of clothing. Stitch Fix, I want to say it was called. I can't remember, but it was basically like they're getting rid of all of their in-house designers and using like virtual, yeah, like whatever the hell the word is I'm looking for. But obviously cutting costs significantly. So, I mean, if you're just looking at a return for a company, I feel like it's probably going to be huge for some stylists. That's what I say, personal stylists that it's just come in to replace.
Okay. So which of the forces would that be in your mind?
I don't know. Where does efficiency lie?
Do you think it'll affect the supply chain, the suppliers? Do you think it'll affect the rivalry? Do you think it'll affect barriers to entry, multiple ones?
I think all of them. I mean,
so that's what you got to say in your write-ups. That's what you got to say in your presentations. Matter of fact, even better, I went back and just reminded myself, if you went back to the Bloomberg Intelligence article I gave you on the industry, it even said Gap, Ralph Lauren are using AI for targeting, and how that is already starting to drive engagement, which suggests that that might actually create a little bit of a barrier to entry in the marketplace, because it gets back to maintaining that brand loyalty and keeping people engaged with them versus going to someplace else. So that would be more favorable to the industry over time, and an argument to maybe the industry won't see a decline in spread, as Bumak said earlier. So again, there's different scenarios we can play out. You don't have to list out every one in your papers or your presentations. I hope you've thought through one and then come up with a point of view of what you think it should be, but that was the key to the I. And you got to reference data. Anybody want to anything else about I before we go to C? All right, so let's talk about C, competitive advantage. So going back to the chart, did Nike demonstrate competitive advantage technically based on our definition? Yes or no, and why? Go back to sharing data screen. So based on this data, did Nike have competitive advantage, or does Nike have competitive advantage? John?
No, because their spread is, I think that's like a, what, 3 point or 2 point some, or yeah, 3.9 compared to a 4.48 for industry average.
Correct. So they're creating value. They're just not outperforming, which, by the way, and I know you don't see historical data, that's not been Nike's historical trend. Like they clearly historically always outperformed the industry. Last 2 years, they have not. And so why? Why is Nike now slightly underperforming the industry? What did you guys read about? Yeah, Tyler?
If I didn't use the numbers, but I gave reasons to why, I think
You'll get partial credit.
Okay. And the reason why Nike's not outperforming the market right now is, one, they have a lot of stale inventory, so they're gonna have to do some steep discounts, and their products currently are like out of fashion, I guess. So companies like Lululemon and Adidas, which have continuously focus on innovating their products and their website as well to drive more people to it and get more conversion rates are seeing growth at the moment, and they're focusing on that growth despite these kind of headwinds right now. So I think in the long term that they're more like they're in a better position. But based on the chart, you also see Adidas not have a great spread.
Sure.
I think
But
they're
the fact that,
sacrificing. Huh?
but the fact that you're saying that Nike is now kind of lagging innovation is really tragic, because that's really what built the company. And it's almost like they've been resting on that and trying to monetize that. And as you said, they're behind the trends. They built products that were less attractive to customers. That's not been their historical game, and they've lost some of their advantage. Evan,
Oh,
go ahead.
Well, just to expand on what Tyler brought up, and kind of pulling in some of the research from the Barclays report and also the Morningstar report that I had pulled, it sounded like they kind of, I won't say abandoned their core customer base, but their innovation, their current methodology for their innovation wasn't in line with their core customer base. So the innovation needed to be not rebranded, but definitely modified, as well as apparently there had been some damage done. So they needed to rebuild like brand partnerships and supply and distributor partnerships again, which the CEO reading, this is obviously in the last couple of weeks, reading his statements from the earnings call, sounded like things were going in the right direction for the company. And then I want to say, yeah, the historic branding, the core base, and the product innovation remain the top three in the earnings call that were mentioned as what they are really going to drive behind with as they move to their win now and so forth for their offense going forwards.
Yeah, no, really good points. John, I saw you had your hand up a minute ago.
Yeah, I was gonna talk about the inventory, but Tyler mentioned that, so.
So the other thing is, and just contextually, if you go back a few years with Nike, they also, opinion, changed their focus. And part of what the previous CEO did is he said, look, we think by capturing direct to consumer, we can capture more margin by bypassing our traditional supply chain. And so I think that has bit them a little bit. Because number one, it kind of took the focus off the innovation of the products and it was more about the innovation of their business model. And then the other piece is it kind of pissed off some of their traditional channels that were pushing their product, which meant that it put pressure on growth because they weren't putting out new and innovative products. They were just trying to get their existing products to you more efficiently. And I think that strategy just got, the pendulum swung a little too far too fast. And I think that's what the new CEO is, if you kind of read the reports, is kind of pulling back on. And they're going back to more of the Nike basics. So that leads to the next question. What about in 5 years? What's their spread going to look like against the industry in 5 years? Are they going to be above average? Are they going to go back to where they were historically? Are they going to remain below average? Are they going to go to about average? So what happens to competitive advantage in 5 years? What do you guys think? Pat?
I said it was going to go above the industry average again, and they were get a competitive advantage. One was the CEO coming in. It sounds like the analysts were really optimistic, and his blueprint for success seems like to make sense, and it's already kind of having positive effect. The other thing is just their brand, their capital, and then the major sporting events they have coming up with Olympics and kind of some of where their brand's positioned. I think there's going to be a lot of eyes on it, and it's going to help kind of position them well in the future.
And say more about the sporting event branding part. Why do you think that's such a driver?
So one of the things I didn't realize is how the market share they had in the soccer and being international. I always think of football, basketball, I guess, because of bias of being in the United States. So I thought seeing that really opened my eyes. I was like, wow, they're really, in terms of the international space, they're positioned really well in terms of not even just the Olympic teams, but some of the pro soccer teams. I think there was a chart. They have Liverpool coming up into 2025, Chelsea they're already doing, Barcelona they've had forever. they're getting the German national team. They have England. They have France. So really, I think they're losing the Portugal team. So I thought those were big stats. And then you throw that on top of the uniform contract history. They have MLB, NBA, and NFL. I thought those were just major drivers in terms of, like with buyers having a lot of power. I think it's really important to control where they're putting their money, and having their brand out in front of everybody in all these big events, I think is going to drive the consumer to purchase them on top of the capital they're using for partnerships with pro athletes and stuff like that.
And whether it's athletes or influencers, that they own a lot of them, essentially own the rights to a lot of them. And I think that's something, historical strategies work very well for them, that they're continuing to go back to. Evan?
Yeah, I mean, Pat brought up all great points, and was going to cover that in way more in depth than I was. But I wanted to add on that there are untapped niche, I won't call it niche, but untapped environments with the rise in popularity of women's sports coming out, getting additional brand deals and pushing into that market. That's an additional sector that Nike's competing for and doing well in so far. But then I also did, and I agree with the sentiment that in 5 years, they should look to recapture the competitive advantage in their domain. But the Barclay report with their Prism analysis, I would also concur that over the next 2 years, you're going to have to see an adherence to the earnings call. I know there was a lot of optimism. It jumped 14.5% the day after the earnings call came out. So shareholders are definitely buying what they're selling. But that being said, I think FY26 and 27 kind of in line with how Barclays laid out their analysis. I would agree it needs to be a rebasing and they need to play all of their chess pieces correctly. But I don't see why not, given their already built infrastructure and brand recognition, that they can't recapture the competitive advantage.
Okay. So we seem to have some consensus that the competitive advantage is just higher spreads for Nike relative to the industry longer term, which is the enthusiasm you're seeing in the analysts that you're referring to. Does anybody disagree with that? And again, it's not wrong to disagree. We're talking about the future. If you can have a point of view that's slightly different. Jacob?
Yeah, so this isn't actually a disagreement. I had my hand raised just before we moved to that question, but I was just going to say that I think that their future competitive advantage also depends on whether or how effectively they capitalize on emerging market consumption. I think that that if they're to focus efforts in marketing within emerging markets, I think that that provides a pretty significant opportunity for revenue growth. But if they don't take advantage of that, then I think that someone else will, and that'll see a significant degradation in the competitive advantage in the future.
Okay, Pat, add it on.
I guess not to argue against my point, but one thing I was considering was just because of some of the trends you're talking about with TikTok and influencers and pro athletes, if a brand like Adidas or Puma or Reebok, something like that, can kind of strike lightning twice or three times and get the right people in place and can kind of shift some of the consumers, I think that could be a risk to Nike. But in terms of their contracts, I don't see that because they've locked up a lot of the top people for the future.
But I don't think it's unreasonable to assume that there is some probability that it does not work out. And I'm just saying you should never be 0 or 1 in anything. You should always be 99%, but never be 100%, because things can happen. And if you've never thought about the opposite, then that's actually kind of bad from a valuation standpoint. Because we start to anchor around our biases here. We just got to be very careful, regardless of what you're saying in the papers. So, Anthony?
I looked at the consumer confidence trends in one of the Bloomberg North American apparel manufacturer outlook, and I looked at the credit card default rate going up by 2 percentage points in less than a year. And then I looked at the Fed's website, and I think we're at higher rates, credit card delinquency rates, than we were during the 2008 financial crisis.
You were correct.
And I'm not I think that really is a terrible omen for consumer spending power going forward in the next 5 years. So I focus pretty heavily on that in my outlook, but I also noted that Nike has a beta lower than 1. So with its strong brand, it'll probably suffer less than its competitors in the apparel space. Like there is no substitute for clothing. Like I don't think we're at like 1930s level yet. But I don't think things are looking too good for like globally based on like US consumer
And I think you make a good point.
debt default.
And so, as I said, it gets tougher when you say 5 years from now because, maybe it's tough for a couple of years and then gets better. Because I do think there is an assumption we're making behind the scenes that the athleisure pie is growing long term globally. And I think Nike as a dominant player in that pie will grow with or faster than the pie. I think that's part of our consensus here, that we're making some assumptions on, which is, I think, why the bias of the group seems to be that they will achieve some competitive advantage in that growing pie. But I think you're right. In the short term, if that pie doesn't grow as much and people trade down, they could have some short-term pain. I think that's, in a way, the part of the short-term danger, meaning they had some missteps. They clearly had some missteps, which they're trying to correct. But at the same time, there's some macro steps that could trip them up regardless in the short term. And you brought another one, the consumer spending, that could affect this as well, short term. But long term, I think most people have a little bit more bullish view. So that would be supportive of what we were just talking about. But that's the whole point. That's EIC. And that's what I want you to talk about in any industry. And when you do your group projects, that's what I want to get the companies out there. Like when you pick your companies, I want you guys to have this level of analysis. Now, when you do your final project, you're gonna have 15 minutes to do all 4 sections. So we can't do 20 minutes on each of the sections like we just did here. You're gonna have to synthesize, but just to start researching the industry. And I'll give you the whiff of part of the reason I'm asking you to do this is when we get to valuation, you're going to be forecasting spreadsheets. You're going to be forecasting revenue. You're going to be forecasting margins. You're going to be forecasting cash flows. Well, this conversation should influence those forecasts because that's the whole point. Like they're not made in a vacuum, right? It's tail wagging the dog, right? Those forecasts for how fast the growth rate is, for whether or not the margins improve or go down, are based on a lot of the things that we just talked about in the EIC. So that's why this kind of course builds as we go through that, the 4 sections of equity analysis. But good summary today of EIC. So as we conclude this, any final comments anybody wants to make here about this? All right. So by the way, I asked my resident TikToker while you guys were talking about the comment I made earlier. And apparently what it is, the TikTok trend for you TikTokers out there is called "Do It Lady." That's the new TikTok trend of the summer. I don't know what that means. I didn't watch all the videos. I try to stay away from TikTok, but regardless, "Do It Lady," and all the variations across that. Robert?
I did the same thing, and I heard it funny. It was different, but it was a funny one. We just kind of talked about the Great Depression, so it fits in. But apparently, another trend is Kit, which was the American Girl doll that they released that apparently survived the Great Depression.
Oh,
So
God.
everybody's saying that it's like Kit's year or whatever.
So "Do It Lady" and Kit. There we go.
Yeah.
We took an MBA class for very important reasons. All right, so let's talk about what's coming up. So week 3, we're going to start moving into the next section of the course. And for many of you, this will probably be the most difficult section. Just giving you a heads up in advance. And the reason why is section 2 is what we'll call historical, all right? Again, can't drive a car or look in the rearview mirror, but we do need a baseline. We do need to understand the past to predict the future. And so we are going to look backwards financially at companies and industries. And so in the McKinsey book, they have an approach which is unique. Okay. It's not really taught elsewhere. The reason it's taught here is because I used to teach in the McKinsey Analyst Training Program back in the 90s. And I knew Dave Wessels, who's one of the authors of that book, and I saw their approach and how practical it was. And so what they do, and you're going to see this week, is a 3-step process for evaluation of companies. And what they do is they take accounting statements and they put them into an economic format tied to Modigliani Miller. And this is the extra step. And then based on that format, they do the analysis and the forecasting. And there's a lot of reasons why that's more efficient, but it's an extra step. And it's a new language that you're going to have to learn, right? Because basically, ironically, what happens is accountants give us data that came from the cash flows, and then we have to convert it back into the cash flows to do evaluation. And so that's kind of what we're doing. We're taking the accounting data, we're converting it into more of a cash flow format so we can do understanding of companies and valuations. And so there's some language that you're going to learn this week, and there's 2 parts to your assignment. Okay. So one of the parts of the assignment is to take accounting statements, income statements and balance sheets, and translate them into these 3 economic statements. The income statement will be translated into something called TII, total income available to investors, tied to Modigliani Miller, a based approach. The balance sheet will be translated into a statement called TFI, and cash flow is income statement minus change in the balance sheet. And that the TII and the TFI will get you to something called CFI, which is the cash flow statement, free cash flows. And that's what we're going to use to forecast. And that's also what we're going to use to analyze and benchmark companies. So part 1, teach you how to do that. Part 2, apply the analytics on 5 years of historical data to look at Ferrari. So I gave you 5 years of Ferrari's historical data, and you're going to analyze that trends using a very specific approach, and you'll see how practical it is from the analytics standpoint, and you're going to analyze their cash flows. And that's going to be your next week's assignment individually. So we'll talk about that in class. But if you struggle with the statements balancing, because that's the other thing, in this class, statements have to balance. So this is what's different about this class versus any other valuation class. When everybody else calculates free cash flow, they stop. Okay, free cash flow, very simply, is profit minus reinvestment. Cash from the income statement minus cash reinvested in the balance sheet. That's it. Okay, and that's your cash that the company's worth. The problem is they never track where that cash goes. In this class, you will track where the cash goes, and you will balance it. So if I generate $1 billion of free cash flow, you will tell me where that $1 billion went, and you will show it to me on the statements, and they will balance. In this class, a non-balanced statement gets 0 credit, no partial credit. I'm not even going to try and figure out what you did wrong. I'm just going to give you a 0. That will be the most challenging part of the assignment going forward. And I'm a stickler for this because in the real world, it's easy to make a mistake and leave something out of a calculation. And that will get you fired and make your firm look bad. And I'm telling you, you're going to hate it because you're going to spend the first 2 statements, you'll get through pretty quickly. Income statement, balance sheet, conversion, pretty simple. The 3rd statement, the CFI, you could spend hours tracking the cash. If you get into that rut, reach out to me for help. Okay? Like, I don't want you 5 hours and give up. Like, I'll try and show me your work. I'll give you some suggestions, but I want you to understand how we balance these statements. It's talked about in the videos, just giving you a preview for next week, but many of you will struggle with that. But when you get to the other side, the entire second half of this class is going to have statements in that format. So it's kind of like learning a language, and you're going to dive right into the pool. So that's where we're going to start in week 3. And this language is very unique to McKinsey, but universal, because that book valuation is the Bible. So final questions before we wrap up today? Lisa?
Is it possible to have more examples or more practice on the statement conversions than the one given as the homework?
Absolutely. Because that's actually, by the way, the midterm exam is just that. I'm gonna give you statements that you're gonna, half the midterm, 10 points of your grade is I'm gonna give you statements, you're gonna have to convert them and balance them. So I'm happy to post some additional examples beyond the homework assignment if you want to practice.
Thank you.
Sure. Any other questions, comments before we wrap up today? All right. Well, everybody, thanks for coming. Have a great week. See you guys next Monday.
Thank you,
sign up.
Professor.
Bye-bye.
Thank you.
Thanks.
All right, thank
Thanks.
you, Professor.
Thank you.